Hello and welcome to Follow the Money. I'm Robert Tan. Join us as we explore the tools and insights you need to jumpstart your financial journey. Today on Follow the Money, we look at the state of the Philippine economy, interest rates, global risks, and the future of Filipino finance. With expectations running high for the Bangko Sentral ng Pilipinas to cut rates and uncertainties arising from global events like the Israel-Iran conflict, we ask, what does this mean for the average Filipino and our economic future? And joining us to share his expertise is Michael Ricafort, Chief Economist at Rizal Commercial Banking Corporation. Welcome to Follow the Money, Sir Mike.
Hi, good afternoon, Robert, and your viewers, and nice to be back.
Okay, thank you for joining us today. So we start our discussion, Mike, with the Bangko Sentral ng Pilipinas. It's widely expected to cut interest rates by 25 basis points on Thursday. Now, do you think the central bank will cut rates? And if so, how much of a cut do you anticipate? And what do you think would the reason be behind this?
Well, it's so possible to see a cut of 25 basis points on Thursday, as widely expected. Because of the easing inflation trend. Very benign inflation at 1.3%. That's the third straight month below the BSP target of 2 to 4%. So therefore, there's still greater leeway, flexibility, and room to maneuver for local monetary authorities to cut rates. But of course, we need to also consider the fact the developments over the weekend since Friday, the latest conflict between Israel and Iran that led to some healthy upward correction in global oil prices to new 4-month highs to around $73 per barrel rather, and that's higher by about $10 compared to a few days ago, late last week. And the peso exchange rate also the highest, corrected higher to the highest in 1.5 months, close today at 56.41 from a low of 55.143 last May 26. So yeah, because there's because higher oil prices and the healthy upward correction in the exchange rate in the dollar peso, but nonetheless the dollar peso is still among the lowest in 8.5 months. So it's still relatively manageable, and realistically there may be some slight pickup in importation costs because of the upward correction in the dollar, as well as of course some pickup in overall inflation with higher oil prices. We have seen that already with the upward adjustments in local fuel pump prices. But nonetheless, we'll see. Even for let's say for the rest of the year, the signaling that we got from the local monetary authorities, additional BSP rate cuts of about 50 basis points from where we are right now. So,
but right now, Mike, do you see with the new developments happening globally, it's still a wait and see what's going to happen next? And to add to that, what do you think are the key factors that the BSP will consider in deciding whether to actually cut the policy rates this week?
Well, first, inflation is still very much manageable. Even with the latest volatility in oil prices and also the slight upward correction in the dollar peso, even for the coming months, because at least food prices are still, especially rice. We still saw year-on-year declines for both, especially both local and foreign or imported rice. And the country experienced relatively better weather conditions since the start of the year, and there's still some increase in the production or output of agricultural commodities, especially food, and that would still lead to relatively benign inflation, and it's still possible, maybe until around August, that inflation could still remain a little less than 2% or close to 2%. And maybe from September to December, there's because of the normalizing base effect, that would be the time that inflation would slightly pick up and normalize towards the 2% levels. And so, well, other factors, of course, if the quarter point cut by the BSP happens on Thursday, so from currently at 5.5% to 5.25%, that would effectively narrow the differential with the US Fed's 4.5% to 75 basis points. That's the narrowest on record.
So you're
Last
still
time we saw
pretty
that.
optimistic despite what's happening globally. And right now we're seeing also a surge in gasoline prices, that the policy rate cuts for the BSP will still be that much.
Yeah, I think it's still relatively manageable. Yeah, like, for instance, if you imagine, the global oil prices are at their highest in since the second week of February. So, and well, we have seen already inflation at below 2% for the third straight month, as of the latest one, May. So, March, April, May. So that's inflation below 2%. And so other factors, of course. Well, there's still a chance that, say, the Fed would also cut rates later this year. The Fed futures are pricing in a little less than 50 basis points cut also. Just a few hours ago, and maybe a few days ago, it was above 50 basis points, or more than two Fed rate cuts. So it's still there. The possibility, although the Fed, their next meeting would be on June 18. But the thing is, no movement yet, no cut yet by the Fed. The expectation is that it could happen around September of this year. Even the Fed officials are consistent in signaling there won't be any Fed rate cut yet.
But looking at the
September.
local economy, Mike, we've heard Congressman Joey Salceda that with the conflict between Israel and Iran, that it could if there's a full-blown conflict, it could actually send oil prices surging, which we're actually seeing. But he's also saying that it could weaken the peso, disrupt labor markets, and push up the cost of imports. Do you agree with such assessment?
Well, that risk is there. Those are, well, of course, the uncertainties there, yes. But we have to note also that, this is this is like the third time at least, well, in terms of a direct confrontation between Israel and Iran. The first time being last April, April of 2024, more than a year ago, rather, and it was followed by another round around July, and also a few months after that. But this time it's different. It's much more, the attacks are if you look at the scale of damage, unlike in the previous ones, it's minimal. Well, it's relatively, the damage back then relatively minimal, and now it looks like it's
much
more
different.
forceful.
Yes.
Yeah, it's much forceful because Iran's it started last Friday when Israel attacked the nuclear facilities of Iran, and also, well, it's really meant to prevent Iran from enriching uranium and developing a nuclear weapon. That's a bottom line. And
Now that being Now that being said, what do you think the government should do now to help mitigate the effects of this ongoing conflict?
Well, first, of course, we have seen for the past 20 or 30 years, when in times like these, in times of geopolitical uncertainty, especially related to the Middle East, to some oil-producing countries like Iran, of course, should there be volatility in world oil and other energy prices and other commodity prices? So, of course, the increased shift towards renewables, away from oil, away from hydrocarbons, and shift towards REs like solar, wind, hydro, geothermal. And that has been ongoing for quite some time already, even before the pandemic, with the away from coal also. So it's aligning with ESG standards, or standards that are friendly to the environment, social, and governance. So, meaning many companies and governments around the world and other institutions have been committing to reduce their carbon emissions, their carbon footprint for the coming years. And, even some global banks have stopped lending to the likes of coal, and really encouraging the shift to renewables. So, that's really meant to also reduce reliance on oil, on imported oil, because the Philippines imports almost all of its oil.
Yes. Now, on another note, Mike, in plain terms, where do you think the Philippine economy is right now? Are we truly in a recovery trajectory, or do you think we're just masking a deeper structural weakness like underemployment, inflation, and heavy debt?
But, the Philippines is still among the fastest growing economies in ASEAN and Asia. Even if the growth is the consensus right now by the multilaterals, credit rating agencies, would be a little less than 6%, or maybe close to 6%. It's a downgrade from, that is revised lower from at least 6% in recent months. Because first, the Trump factor caused the economic slowdown, the uncertainties over the Trump tariffs, the trade wars. Of course, that's going to slow down exports to the U.S. by many countries around the world. There's uncertainty on the tariffs by Trump. It's still, yet to determine, because it's still under negotiation. Currently, the baseline tariffs is at 10%. From the reciprocal tariffs last April 2, it was revised to 10%, except for China's 30%, coming from a high of 145%. But that was already significantly reduced to 30% by since May 12, or more than a month ago. So now the 90-day pause on the reciprocal tariffs, it's due by July 9, and that would be the next critical date. There have been talks that the U.S. or the Trump administration could adjust the reciprocal tariffs from 10% for the baseline, actually the baseline tariffs, to 15% for 150 days. So, but it's still uncertain because negotiations are ongoing with various countries, and it's with that uncertainty. Well, those with bigger headaches would be the exporters. They don't know, especially those who export a lot to the U.S. And what would be the level of tariff? And uncertainty doesn't help. It would slow down demand. Everybody's on wait and see. Even new investments. Of course, bigger headache in managing inventories, in the capacities, and how would they invest in new FDIs, new expansion projects. That's around the world, the global supply chains.
But if we look, Mike, if we look at it on a micro level here, for the average Filipinos, for the smaller businesses, the MSMEs, now looking at it with the inflation staying sticky and interest rates still elevated, now how should the average Filipino, or the breadwinners, the MSMEs, adjust their financial behavior today? Do you think they should save more, borrow less? How can they invest smarter, or all of the above, in line with what's happening globally that is affecting our local economy?
Yeah, it's consistent, true. As you mentioned, normally, even, of course, with the volatility in oil, of course, it's the saving measures. That's always there, the conservation measures, and other than the shift to renewables, and being conservative also on the financials, because, there would be some slight slowdown because of the slowdown in global trade, the slowdown in global investments, employment, and eventually the world GDP, and indirectly it would slow down the Philippine economy. And of course, the hardest hit would be the exporters because of that uncertainty. The Philippines export 17% of the total to the U.S., and there's a chance that if many exporters around the world, they won't be able to sell to the U.S. They may have to sell elsewhere. So we may see a potential increase in imports, but that would be a function if the reciprocal tariffs would be high for many countries. So it's still a wait and see, though. And the uncertainties on the Middle East, it's of course it's gonna lead to some pickup in prices, starting with petroleum and some pickup in import prices because of volatility also, or a slightly weaker peso recently. And it would, it's better to be conservative, of course, because bottom line, as far as the Philippine companies and businesses are concerned, some slowdown in
Yeah.
sales, in earnings, and of course, some possibility of some job losses,
Yeah.
especially those employed in the global supply chains for the various export industries around the world, that may
Yeah.
include some Philippine OFWs, or
Mike,
even those
yes.
employed here.
Mike, before we continue on that trajectory, yes, we'd still like to discuss a lot about how the average Filipino and the local MSCs are affected by what's happening globally and how it's affecting our local economy. And we're just getting warmed up. Stick around, follow the money returns right after this short break. You're still with us on Follow the Money. We're exploring everything from the expected BSP rate cuts and global risks to how Filipinos and MSMEs can navigate today's economic challenges and opportunities with Michael Ricafort, Chief Economist at Rizal Commercial Banking Corporation. Okay, Mike, we were discussing before the break, how does it really affect the average Filipinos and the MSMEs? Because if we look at on a macro scale, we tend to forget how these what's happening globally affects not only the local economy, but the average Filipino in terms of their purchasing power, our MSMEs in terms of what do they do now because of what's happening. They're struggling right now. So what can the government do to help mitigate all this and help the average Filipino and our MSMEs?
Well, now, of course, it's really a matter of, because of the slower global trade, slower global GDP or economic growth due to the higher tariffs in the US and the trade wars by the Trump administration. So, of course, it starts also with the directly hit businesses, the exporters. They may have to downscale. Of course, they would experience reduced sales, reduced profits, and they may have to adjust lower their production and even their capacity. And even the suppliers, the supply chains would be adversely affected. It could lead to less sales and for the various value chains or suppliers, and could even lead to some job losses. And the solution to that, of course, is to diversify further the export markets, and because it's 17% of the total exports to the US, so it's really about it's either, of course, negotiating for the free trade agreement finally with the US, but of course that would realistically take some time, and diversification of the markets by tapping promising markets in the Middle East, in Europe, and in other parts of Asia. Especially, we already have a lot of free trade agreements in Asia Pacific region with multilaterally with ASEAN, China, Japan, South Korea, Australia, New Zealand, India, and so on, and many other markets, and also to diversify also the export winners, especially the agricultural exports that have yet to really move in line with the other countries. And if you look at our exports, the Philippine merchandise exports, the goods exports, are like 3 to 5 times smaller compared to more developed ASEAN countries. So they have a bigger headache than us. The bigger ASEAN and Asian exporters. And locally, of course, the conservation measures, and other than that, it's really it's shifting towards renewables, reducing further the dependence on imported oil and other hydrocarbons, other energy products. Of course, that's true. Well, we have seen for the past 1 to 2 years, the biggest foreign direct investments into the country are largely renewables, offshore wind, and solar, and so on. So, to increase.
Yeah.
Yeah, go ahead, Robert.
Yeah. With that being said, Mike, what would be your advice to the average worker, the average employer, on how they can stretch their budget or invest in a time like it is right now?
Well, of course, important to be conservative from an investment perspective. You know, the risk there could be some deterioration on well the normally asset quality. Why? Because the reduced sales, reduced profits, and some risk of job losses that could lead to some reduction in the ability to pay by some borrowers. So normally you always go to the safer asset classes like government securities, the safest credits from an investment perspective. Yeah, because it's a credit issue
A bit
now.
more in the
If you
the
have,
low risk kind of investments, but long term.
yeah, actually it depends on their cash flow. As long as the safest credits, the safest sovereigns, and especially that long-term interest rates remain relatively elevated, and even short-term interest rates are yet to be cut further. So it's still attractive for those looking for yield to maturity or invest in interest income. But of course, that should be carefully mixed with their appetite. To manage a market risk, especially. That's why they go for the preference would be at the belly of the yield curve, 5 years and shorter. They'll just wait for the bonds to mature and get to enjoy the relatively higher interest rate income or the yield to maturity. And
More on the long term. Yes.
While eliminating the market risk at the same time. And of course, very conservative on finances because there are other challenges. Like now, we have yet to see if the legislated wage hike would
Yes, that's
take
one
effect.
thing we're still looking at also, whether it's going to happen. Yes.
Yeah, but of course, it's still subject to a lot of. It's still being studied carefully.
Yeah.
We already saw the stance by the economic team. So it's really
Again, wait and see. But Mike, as an economist, let's say if you had direct access to the president, the BSP governor, and the Department of Finance secretary in one room, as an economist, what's one urgent economic recommendation do you think you could give them today? What kind of policy would you push to create immediate and long-term impact today?
Well, of course, it's still the more reform measures like pertaining to the management of the country's fiscal performance, the budget deficits, try to narrow them further to more sustainable levels, to enable to bring down the debt to GDP ratio currently at 62% as of the first quarter to below the international standard of 60%. And of course, there are pending reform measures on the fiscal side, like the right sizing of the government.
Now,
Enable to boost the
Yes.
to
Go ahead.
boost
Go ahead.
the productivity of the government. Meaning to say that's the use of technology to make everything more digital. Imagine even the payment of taxes at the LGU level. Well, of course, everything else is already online
Yes.
on e-commerce. So even the payment of realty taxes or property
There's no way
taxes
around
should
it. We
be
all have
online,
to go
right?
digital now. Yes.
Yeah, those things. So, well, actually, the intention of that is to make the government more productive through the use of the best technologies available, the best digital technologies, and also bring down costs at the same time. Of course, more disciplined spending, anti-leakage, anti-wastage, anti-corruption. It all starts and ends with good
still
governance.
lots to do, still a lot of learnings. But Mike, as a final question, as we look towards the next 5 to 10 years, what is your message to Filipinos who want to thrive in an uncertain global economy? And what kind of opportunities do you think they should seize now? And what kind of mindset do you think we should adopt to secure a better financial future?
There are two biggest important things for the country to really. There's still gaps, and the gaps represent opportunities. Gaps in infrastructure, gaps in productivity like in agriculture, and in manufacturing in the industry sector. So First, it's on the education, the STEM courses, science, technology, engineering, mathematics. Our population is the 12th largest in the world, so to make our population more productive and in the future. And of course, technology is the biggest equalizer also on top of education. That would really expedite the success of, especially in narrowing the gaps. Further mechanizing agriculture, the best technologies in terms of the higher yielding varieties and the infrastructure, the cold storage facilities, irrigation, etc. But it's really adapting the best technologies, say those used by the likes of Israel. Israel exports fruits to Europe despite limitation on the fertile land. They use greenhouses, and actually that's already at least. It's already being adopted by one of the biggest conglomerates here in the Philippines.
I guess it's really trying to adapt with what's happening globally and locally here. And anyway, thank you, Mike, for your insights and imparting your knowledge about the economy and giving your insights to our viewers on how to look forward in terms of trying to grow their money. Thank you, Michael Ricafort, Chief Economist at RCBC, for sharing your insights on BSP's policy moves, global risks, and the future of the Philippine economy.
Thank you so much, Robert, and to your viewers. Have a great day.
Okay, and before we go, a brief reminder from Professor of the University of Texas at Austin, James Galbraith. Inflation applies the law of the jungle to war finance. Wages fall, profits rise, savings erode, thugs, profiteers, and well-connected get rich. And that's it for today's edition of Follow the Money. I'm Robert Tan. Thank you for watching. Keep it here on BNC, the Bilyonaryo News Channel.